They believe that stock picking will overshadow the prevailing macro headwinds. Let's discuss this in great detail with Manishi Raychaudhuri of BNP Paribas, who is joining us right now on the show. Manishi, great to have you, and an encouraging target on the Sensex, a 10% upside from you. What has led to you? What has led behind this target? As in, what is the thought process behind this target, and where do you think leadership is going to come from?
Okay. We are actually positive and overweight on the Indian market in our Asia ex Japan model portfolio for 2020. As far as the target is concerned, we think that there's unlikely to be much re-rating from the present levels, but even if one factors in a pretty similar price to book multiple for the market 1 year ahead, one would arrive at the kind of a target that we are talking about. We're also seeing some degree of improvement in return on equity. And this applies to the entire emerging market and Asian emerging market universe, not just to India, driven primarily by improving asset turnovers. So these are, I think, some of the contributing factors that led to our call on the market. As far as our overweight stance goes, we think that Indian market offers some degree of ease of stock selection to the foreign investors. As we have repeatedly said, that Indian market offers a significant spread of compounders, companies that have been generating excess ROE compared to their cost of equity. And I think that's one of the reasons why FIIs have significantly been attracted to this market historically.
All right. With regards to where you're going to see a lot more action, is it going to be the cyclicals that are going to see leadership in 2020? Is it going to be financials which will continue to lead? We've seen a little bit of a backdrop here where financials are looking slightly more tepid, but that's just a phenomenon of the last few weeks. Mid caps and small caps in the broader market selection. I mean, right. you've got a huge market to choose from where there is a beta. So what would you recommend?
Right. As far as our sector preferences go, we're still banking on the financials, private sector banks, and insurance. We have actually added to the TMT universe both tech and telecom in India. And we also think that the select energy companies and some of the public sector companies with relatively strong dividend yields could actually stand the investor in good stead for 2020. As far as your question about mid caps and small caps go, there's a degree of divergence in valuation even within that space. So the relatively high quality mid caps are trading at a significant premium to the second and third tier mid caps. So I think one would have to be discerning even within mid caps and small caps in terms of selecting stocks which are secular excess return generators, and overlaying that with a relatively inexpensive valuation consideration.
Manishi, there's been quite of a de-link when it comes to what the economy is doing in India and what the markets have been doing. Of course, markets globally have been supported with liquidity.
Right.
And as you mentioned, FI community, we've seen the flows coming back in the last 3 or 4 months. So that's, of course, supporting Indian equities as well. Any key concerns when you interact with these FIs who invest in India that they highlight with regard to what's happening with the economy, or any key expectation from the upcoming budget?
Right. See, as you rightly highlighted, that this buoyancy in equity markets is not an India-specific phenomenon. So right from mid-September, when global equity markets or emerging markets bottomed out, we have had a rally. In fact, the North Asian markets, let's say China or Taiwan, they have actually moved up even faster than South Asia or India. So this has been a liquidity-driven rally, and we think that while there may be short-term fluctuations in liquidity inflows over 2020, this would be an ongoing trend, because we're likely to see currency moderation, particularly US dollar moderation, and the emerging market currencies are likely to be more stable than they had been historically, which is obviously a supportive factor for FII flows to continue. That said, you also rightly pointed out that while this rally had been in progress, we have had a consistent downgrade to economic growth numbers and to corporate earnings growth, which is possibly more important in the market context. So I think the concerns that investors have right now are predominantly about corporate earnings. The questions that we face are, when are we likely to see the bottoming out of earnings revisions, or some kind of an improvement in the revisions towards the positive side? And at the same time, what are the kind of supportive measures that the government or central bank can take in terms of supporting and eventually improving domestic consumption?
You spoke about the earnings growth, and we've been waiting for that 20% plus earnings growth for last many years. What are you guys penciling in with regard to next year or this whole FY20 earnings growth to be?
So as far as FY20 is concerned, we are almost at the end of it. So current EPS growth forecast for Sensex or MSCI India is just in the early double digits, somewhere around 11 to 12% or in early teens. Now remember that 1 year ago, when we were at the beginning of 2019, fiscal 20 consensus growth estimate was more than 20%. So that 20% growth number has been gradually whittled down in course of the year to reach the present levels of about 11 to 12%, and even that is being predominantly contributed by the financial sector. So if you take out the private sector banks, hardly anything would be left as far as earnings growth goes. Next year, fiscal 21 is now becoming important, and I'm seeing that the consensus earnings growth number for fiscal 21 is again in the range of about 23 to 25%, which looks like a bit of an overstretch to me. I mean, we believe that it would eventually settle at about mid-teens levels, which would be better than fiscal 20, but clearly not as strong as the current consensus numbers are telling us. That said, we think that the worst of earnings downgrades are possibly behind us, and so to that extent, I think the earnings stability may actually come through towards the middle of next fiscal year.
Okay. Manishi, hi, Neeraj here. Just one final question. The big theme for 2020 is centered, or one of the big themes, let me put it that way, is centered around divestment. And we know that the oil and gas companies or the OMCs might actually be first off the block, even though it may not happen in this quarter. What's your sense of whether the government can get a value which is much higher than what the current EV/EBITDA multiple suggests? I mean, and will that bring about a positivity towards the whole divestment drive of the government?
Well, we are not factoring in any significant uptick to the valuations that the government can get. In fact, I think it may be a good idea for any seller, I mean, I'm not just talking about the government, to leave and, some kind of an upside for the buyer. In fact, selling them, or asset sales or divestments at reasonable valuations may actually be a better outcome, and it may even be more sustainable to, as far as continuation of the divestment process is concerned. If we do have some of the, the companies that the government has talked about being actually executed, that would clearly be a significant impetus towards the positive sentiment, because it would give an indication to the market that the government is able to raise fiscal resources inorganically, without having to depend on the tax revenues, which have obviously been unstable in recent times. So yes, I mean, that's a space that we're keenly watching for. We must point out that it's not just purely company sales or divestment of companies, but also asset sales, assets that are owned by these companies and government departments, which could potentially be raising resources for the government.